Welcome to the Microcap Brief, your guide to navigating the unique opportunities and challenges of the smallest publicly traded companies. Today, we're tackling a corporate action that often sends shivers down investors' spines, the reverse stock split. Is it a desperate last gasp, a necessary evil, or sometimes even a strategic move? Let's cut through the noise and understand what it really means for your microcap investments. Picture this. A microcap stock you own has been languishing below $1 for months. Suddenly, the company announces a 1-for-10 reverse stock split. Overnight, the share price jumps to $5, but your number of shares shrinks dramatically. Do you feel relief? Or do you hear alarm bells? The truth, as usual in the world of microcaps, lies in the context. So, what exactly is a reverse stock split? At its core, a reverse stock split is simple arithmetic. The company reduces the total number of its outstanding shares. For example, in a 1-for-5 reverse split, every 5 shares you own become one single share. Crucially, the value of your investment does not change at that moment. If you owned 100 shares worth 50 cents each for a $50 total, you would now own 20 shares after the split. To keep your total stake the same, each new share must be worth $2.50. The share price increases proportionally, but your percentage ownership and the company's overall market value remain identical. It's like cutting a pizza into fewer larger slices. The pizza itself hasn't gotten any bigger. So why would a company do this? The most common and urgent reason is to maintain its exchange listing. Major exchanges, like Nasdaq, require companies to keep their stock price above a minimum bid price, typically $1. If a stock trades below that level for too long, it faces being kicked off the exchange. A reverse split is a direct, though artificial way to lift the share price back into compliance. It buys the company time. While compliance is the main driver, companies sometimes cite other reasons. Management might believe a higher share price appears more respectable to large institutional investors, who may have rules against buying stocks under $5. A company on the OTC markets might also use a reverse split to meet the minimum price requirement needed to uplist to a major exchange like Nasdaq. However, this is where you, the investor, need to sharpen your pencil. A reverse split does not fix a company's underlying problems. It doesn't create new revenue, improve a product, or pay down debt. In fact, it is often a significant red flag. It signals that the business has been struggling, perhaps with declining sales or mounting losses, which caused the stock price to fall in the first place. A history of multiple reverse splits is a massive warning sign, suggesting a company is stuck in a cycle of decline, using financial tricks to survive rather than fixing the core business. The most critical test is what happens after the split. Does the new higher price hold, or does it quickly begin to drift back down? A sustained decline after a split is a powerful signal that the market has no confidence in a real turnaround. It sees the split for what it was, a temporary band-aid. For microcap investors, understanding this is vital. First, it helps you preserve your capital. Recognizing the red flags can help you decide whether to hold a stock or exit your position before further losses. Second, it's a report card on management. Is the split part of a credible turnaround plan, or is it a sign of a leadership team that is out of ideas? The company's SEC filings will reveal their rationale. Third, it helps you avoid value traps. A stock that magically jumps from 20 cents to $2 looks better on a screen, but if the business fundamentals haven't changed, it's a classic trap. And finally, a reverse split often signals that more dilution is coming. The company may use the higher share price as a platform to sell more stock and raise cash, which can shrink your ownership stake even further. So, is a reverse stock split a survival tactic or a red flag? The answer is it can be both, but the context is king. It becomes a major red flag when it signals persistent weakness, is part of a repeated pattern, or is not backed by a credible plan for recovery. A reverse split should never be viewed in isolation. Here's your key takeaway. A reverse split is a neutral financial event. It only becomes positive or negative based on the company's underlying health and its actions that follow. Don't be fooled by the higher share price. Dig deeper. Review the financials, read management's explanation, and look for a concrete plan for improvement. Your homework is simple. If a company you own announces a reverse split, go straight to the source. Read the 8K filing that announces the split and the other documents that detail the reasons. Ask yourself, is this a lifeline for a viable business, or is it a warning sign of deeper trouble? Always do your own research. That's it for this episode of the Microcap Brief. Remember, knowledge is your most valuable asset in this space. Stay vigilant, stay informed, and we'll see you next time.